This video follows the voice message left by Gary on Twitter and Telegram, the links to which we will put in the description of this video. Blackwave is now going to recreate its most successful grid trading strategy, called Blackwave Pacific, which traded for 7 years, and equip it with new safety features. We will discuss what was Blackwave Pacific in its original format. How did a grid trading system last so long? Why did it ultimately fail? What lessons can be learned from the failure to protect a newly created Blackwave Pacific 2.0? Then we will give you the amended strategy, so stick around to the end to find out how a grid trading system capable of lasting 7 years has been improved.
What was Blackwave Pacific? Blackwave Pacific, whose my FX book statistics are behind me, was a grid trading strategy. It grew from observing the trading of another trader who called himself Gold Star. Gold Star was a Dutch trader living in the Far East in 2014, trading gold on a grid system. Blackwave decided to improve on it by taking counter-trend trades when the market was either technically oversold or overbought. It would trade major and minor forex pairs in order to focus on the most overbought or oversold pairs rather than just gold. It would not trade exotic pairs to reduce the geopolitical uncertainty around such pairs, like the Turkish lira or Mexican peso. Furthermore, the overnight swaps on exotic pairs can eat into a significant part of the profit. Blackwave Pacific traded on a swing trading time frame too, so trades lasted days and weeks rather than minutes or hours. The idea was that once position size was conservative and the positions were reasonably spaced apart, it would be very difficult not to make money on the inevitable reversal. For added safety, it used linear position sizes, which is to say no martingale. Position sizes remained the same size. Furthermore, there could be no more than 12 positions and no more than 2 pairs trading at any one time. As you might correctly guess, risk control was achieved through position size. To give you an exaggerated example, if you are trading euro-dollar with this 12-position grid at 0.01 lots per trade in a 1 million euro account, it would simply be impossible to lose because the balance of your account would completely overwhelm any possible drawdown until the position became profitable. Of course, it would also not really be worth your while doing this in a 1 million euro account, but Blackwave Pacific recognized the logic and tried to find a correct position size that was safe, but still also worth it.
How did it last so long? The major generic criticism of Blackwave Pacific over the years from August 2015 to its failure in September 2022 and of all grid strategies is number 1. Adding to a losing position is not recommended. Instead, you should add only to a winning position. Number 2. If there is no hard stop loss, then everything is at risk. However, this argument is stronger with shorter-term timeframes. In grid trading, the time frame is not necessarily extended and often short-term. Using swing trading timeframes, however, Blackwave Pacific ensured that events such as non-farm payrolls were not make or break for the account, whereas shorter-term timeframes could get into difficulty around these events very quickly. Grid trading often operates on shorter timeframes, but the principles of avoiding excessive exposure to short-term market noise were applied by Blackwave Pacific. By setting up the grid with wider intervals, the strategy aimed to capture medium-term trend reversals off overbought or oversold conditions while filtering out short-term fluctuations. Lower position sizes are fundamental in grid trading to manage risk effectively. Each grid level represents a separate trade, and by reducing the size of each trade, we could control potential losses. This is crucial in grid trading because unfavorable price movements can trigger multiple trades simultaneously. The triggering of multiple trades simultaneously was avoided at Blackwave Pacific because we traded it manually and not with a robot or EA. There was an actual trader pushing the button when conditions settled down. Furthermore, the smaller position sizes contributed to better risk distribution and overall risk management. Blackwave Pacific traded roughly 0.01 lots per $1,700 of capital, with a maximum of 12 positions spread widely and no more than 2 pairs traded at once. It was extremely robust, and by 2018 profits had been accumulating at over 5% per month on average for 3 years and were becoming exponential. We began to diversify into property and stocks. In 2021, we paid for the upgrading of a children's schoolyard using PayPal subscriptions from our subscribers on MQL5 and Signal Start. All guns were firing right throughout the COVID pandemic. The strategy was well-defined and easy to execute. Just wait for overbought or oversold RSI conditions on daily or weekly timeframes. Begin the counter-trend grid, control position size, and keep the distance between positions wide enough. Where most traders shot a bazooka side position at one single spot on the graph with a tight stop loss, then would naturally and inevitably be hit. We had 12 small bullets, 12 small positions if needed spread wide to give a nice average entry. Then just wait for the reversal. Simple, effective, and hugely profitable. Winners would take care of themselves. Losers would be averaged until break even at worst. Amazing. What could go wrong?
What went wrong was that after the pandemic was over and restrictions on work and trade were lifted, there was an inflationary boom. This sudden and massive spike in demand caused lots of uncertainty around how central banks would react. It became a race to raise interest rates to control inflation, with first the dollar strengthening massively and then other currencies in turn. Trends that used to last for weeks now lasted for months, and trading counter trends suddenly becomes perilous. While it was ultimately a profitable trade, we ended up in a euro-sterling position that went on for more than a year. The environment had changed, and we began to introduce ad hoc hedging to cope, but it was not formalized into the trading plan. We continued trading counter trend, buying the pound against Swiss franc, betting on a swing trade out of oversold conditions. Then came a type of black swan event. The new British Prime Minister Liz Truss introduced a budget of spending increases and tax cuts to be paid for with increased borrowing. Sterling began a more aggressive decline. On Sunday night, 25th September 2022, about an hour after the market opened in Asian hours, there was a sudden and massive decline that caused a margin call, and everything was wiped out. The difference between the high and the low that week was 900 pips, and the rally was just as sudden, but it no longer mattered. First, her chancellor resigned, and then Liz Truss herself, making her the shortest British Prime Minister in history.
To be clear and fair to Liz Truss, it was not her fault that our account did not have enough safety features built in. 7 years of trading at that point made us think we have seen it all, but we hadn't. What would have worked would have been an automatic hedge at even a 50% drawdown, or alternatively, perhaps a hard stop much earlier in the trade. In the hedge scenario, sterling franc would have declined 900 pips, then reversed, and we may have been able to fully or partially close the hedge at break-even. We may have even ultimately made a profit on the original trade as it subsequently climbed higher. What a difference different decisions can make. So now let's see what changes we have made in the amended strategy.
There can only be 2 currency pairs trading at once, such as Euro-Dollar and Aussie-New Zealand, for example. The aim is not that the 2 pairs trading would be inversely correlated, but certainly that they would be mostly unrelated. The grid begins by risking 0.3% on the first position. There may be up to 10 positions. The aim is for a soft stop loss of 17% on either of the 2 pairs. This effectively means we recognize there is a fundamental problem with the trade at 17%. Drawdown irrespective of how many positions in the grid have been opened. Hedging begins sooner and is now formally incorporated into the Blackwave Pacific strategy. If we are forced into even the 5th of our possible 10 positions, we automatically open a hedge using the same position size. For example, if we are trading Euro-Dollar at 0.3 lots long, then there will be 5 trades at 0.3 lots, and now 1 sell order at 0.3 lots too. It is a recognition that the trade is not working, or not working yet. We will do the same if we are forced into a 7th position. Therefore, at the 7th position, we have 2 trades going in the opposite direction and are already 28% hedged. The original long positions will be able to pay for the hedges, or we may be able to close one of the hedges at break, even if we get the reversal we were looking for. However, the grid may still get to a 10th position, at which point we would be 20% hedged. If the second currency pair is profitable, say Aussie-New Zealand, we will continue to use some of that profit to essentially eat the drawdown in euro-dollar, beginning with the biggest losers to improve average entry. If the original euro-dollar trade becomes profitable, it will be possible to use the profit to eat the 1/5 of the position that was hedged, or indeed we may be able to close one or both hedges at break, even if we get the reversal we were looking for. However, if the trend continues further against us, we hedge the remaining 80% of the position at a 25% drawdown in euro-dollar. We now actually have an average entry on the hedge from position 5 and a 25% drawdown fully hedged against further deterioration. This would have saved the account in the sterling Swiss franc scenario of September 2022. In the unlikely event that both currency pairs reach a 25% drawdown simultaneously and become fully hedged each, we will close one of them completely for a 25% loss, leaving us with one position once more and the ability to trade out of the loss and regain the 25%. These are the basics. To give any more information would be to reduce our flexibility and take away the major advantage of a manual strategy and make it effectively automated. We like to watch all markets at once and get a sense of what's going on.
Let us recap. So what's new? 1. Only 10 positions in the grid instead of 12 reduces risk by reducing the accumulated position size. This should not reduce profit. 2. Hedging is now formally incorporated and begins at position 5, means that by position 10 the trade is already 20% hedged. 3. The position is fully hedged at a 25% drawdown. 4. If both currency pairs get into a fully hedged 25% drawdown each, then one position is fully closed for a 25% loss to the account, and we just one currency pair open and a free hand to begin adding profits again. 5. Finally, in a complete departure, we will now begin adding to our winners, the complete opposite of adding to your losers. When we are right, we want to maximize the profit.
We think we have taken the very best of Blackwave Pacific and kept it. It produced more than 5% per month returns for 7 years, and we have tried to not mess with that. Hedging will either begin at position 5 and continue at position 7, or be fully hedged at a 25% drawdown, or both. In most scenarios, we hope to not get to position 5, in which case Blackwave Pacific is the same old strategy producing the same results. We made a mistake to change the strategy after the sterling Swiss franc upheaval in 2022. It cost you money, and since we always have skin in the game, it cost us too. This the responsibility we take. We rise and fall together as it should be. Instead, we should have taken the advice that says, quote, "Profitable traders are specialists. They pick one setup, one market, one strategy, and go tunnel vision on it." This we have now done. While the working title was Blackwave Pacific 2.0, the actual name is now Blackwave Pacific Hedged. We look forward to working with our clients old and new at Blackwell, at IC Markets, MQL5, and at Signal Start. All links in the description. Thank you.